What's going on, everyone? I'm here again to look at another stock. And what stock am I going to look at? Well, before that, like and subscribe to my video, and let's talk about this.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company, I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer?
So what are my requirements for my dividend portfolio?
The important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book.
Number one, it has to have good growth. Number two, it has to be financially stable. Number three, it has to have a good possibility of growth. So I'm doing this to build up my passive income. And
the biggest way to not be on a beach in Mexico is to think that passive income exists. I think the reason so many scumbuckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate.
This is the thing about it. My strategy is very simple. I look at the numbers, and it's pretty much based off my decision. And what stock am I going to look at? The stock I'm going to look at today is ADP. Now, if you don't know what ADP is, they're a informational center. They do.
When I'm talking to people about ADP and what I do for a living, it really, it starts off with just like, we're a large payroll company. We touch millions of people's lives every day, but then it goes into like, we build the products for the daily experiences that people have. So whether you're checking your payroll, you want to make sure your deductions are right. You're going out.
HR, they do payroll, they do all this information for companies. Now, I have my own thoughts on this, but they're pretty much a flexible, effortless payroll HR for companies of all sizes. So yes, I've seen people use this. A lot of people use it, and it helps out. So Amazon uses it, Dell, American Woodwork, and Scotts. So they do have some big company, especially if they have AI involved. So is this going to be a good company to invest in? So now that we know what ADP is, and if you don't know what it stands for, it's automatic data processes. So it processes all the data. It has good technologies. It has good human resources, client services. They're trusted and they're flexible. Let's check what the investor says. So for fiscal year 24, revenue is $19 billion. Client is 1.1 million. And they are doing pretty well. So they support everything from HR, payroll, time, benefits, HR related issue, talent, compliance, and retirement. So they do a lot of different things, and they're really in the United States and South America. And it looks like it's spreading everywhere besides like Russia. So let's see what their portfolio is breaking down to. Looks like they have pretty good portfolio. All right. Based off of information, looks like it's pretty good company. So let's go into the stock and see what it really has been doing. So let's see. In 1 month, it grew about 3.5%. That's pretty good. Year to date, it grew 5.43. 1 year is 23.66. 3 years is 28%, so about 12. And then 5 years is 112%. That's a pretty good growth overall. So let's go ahead and look at the dividend. So let's look at the dividend now. So the automatic ADP. So it pays a dividend yield of 2.0% and an annual dividend payout of $6. Pretty good dividend payout. Dividend growth is 10.46% and it's been growing dividend for the last 50 years. So it's been doing pretty well in the dividend growth. So it looks like it's Aristocrat King. If you don't know what Aristocrat King is,
what is a dividend king? A dividend king is a company that has been paying and increasing their dividend for the past 50 years. There are currently only 48 of these companies left in the US, and some of these companies include Coke, Pepsi.
Get back to this. So we now know that it has a good dividend yield and it has decent growth. So let's look at the finance to understand if this is worth adding to my portfolio. Now, like I said, I do like using MSN a lot better because if you don't know what something is, you can go to the side and it can tell you like revenue. Investors measure growth by how fast company revenue sell and growth year over year compared to the competition or past levels. So I like to compare it year over year, see how well they're growing. And it looks like it grows about $1 billion to $500 million every year. And that's a pretty decent growth at that size of company. But what I really like to look at is the gross margin because that's where you know how much profit they're making, and it's at 45.62% with a net profit of 19.54%. And if you don't know what a net profit is, net profit shows how much of each dollar in revenue transition into profit. Higher is better. And then this is where you get to see it. And then there's things like operational income. If you don't know what operational income is, it's a gross profit minus operation expense, shows a percentage of revenue. A good indication of profit is higher is better. Okay, they're at 25.76%. But you also have to remember every single time you look at one of these expense reports for finances, this doesn't tell you the true number because they can always fudge the number and change it. The real thing you need to do is look at the balance sheet and see if the current asset is going up or down. And this is where it'll tell you if they're doing better, if they're selling assets, if they're worth. What I use this page for is to see what's the current liability and long-term debt is versus what the current asset is in fixed asset. Because if it's more than their worth, their liability, I don't buy them. Just because if something happens, they're not worth that much and they could go bankrupt. Even though their money might look good, if they're borrowing more than they are really earning or worth, then it's not worth having in my opinion. So the current asset in 2024 is $45 billion with the fixed asset of $8 billion. So that's roughly about $53 billion of assets. Now, if I could go into intangible things, but I don't like using it. I like to use the current liability and long-term debt. So 45 plus $2 billion is $47 billion. So they're worth about $6 billion if everything's sold today. Now, this is just a rough number. So yes, they are worth more, but in my honest opinion, $6 billion for this size company doesn't really make me happy with the liability risk. It's kind of a high number for it. So let's look at how well has the operational cash flow been doing. So every year the operational cash flow has been increasing. And if you don't know what operation cash flow is, cash generated by the business company to operate. So right now it costs $4.16 billion to operate. And then let's look how much investment cash flow they have. And this is just by getting money from the investors. So -$1 million, -$2 billion, $2 billion. 2022 is -$7 billion. Okay. Now let's look at the most important one is free cash flow. And if you don't know what free cash flow, it is the money left over after paying operational expense and capital expenditure. And this is the thing. I like to see this number go up every year. If it does not go up every year, I think they might be having some issues and I will not buy them. So they're at 2017, they are at 1.6 million or billion, 2 billion, and it goes all the way up until 2024 when they went to 3.9 or 3.59 billion, and 2023 is 3.64 billion, which is, to me, why are you losing money? Because if that means that year they have a loss of a cash flow, roughly about, $50 million is not being reported of a loss. Maybe it's because of the books, but according to their financial summary or their finances, they make money every year. So they lost about $15 million in transition of somewhere on here that makes me question what happened. They do have a good net profit. They do have a good gross margin, but on their cash flow, they lost about $50 million. And that makes me concerned if I want to invest, because you can make a bunch of things up and make it pass for the financial income statement and the balance sheet, but the cash flow doesn't lie because they have to report this. So last year they did lose a little bit money, and they did in 2021 and 2022, they did lose a little bit more cash flow. And it might be because they're paying off debt, but we'll see, because at the end of the day, I need to look at everything. So let's see what the analyst says about it. The analyst says the earning for ADP is 3.06, which is not that bad. And if you don't know what it is, the company earnings is divided by shares outstanding. So it's not that bad. So let's see who invested, because that's BlackRock is selling some of their shares, which is interesting. State Street is selling some of them, and Vanguard bought some. So that'll be interesting. So people are selling it. The company, okay. Now this might not be a big concern for everyone, but for me it kind of is, because almost everyone on here that got some stocks looks like they sold it. So does that mean the company's doing bad? No, but it does mean that when they sell this every year, every quarter, it makes it harder to grow the company stock, especially if you're selling 1K, 2K. It's not a very big number, but it does indicate on there that for some people that they are selling, and it causes a little bit of disruption. In my personal opinion, this is why I don't like seeing people sell, because if you notice it, this person sold 2K, that's $458,000. And this is not going to be an everyday thing for most people. So if you see this, it's going to cause a small dip that day. You see, some of this might, but it could cause a chain reaction and cause the stock to have issues for growth. Now, let's see what AI says, because that's the most important part, is to also use AI in the valuation. So the valuation is 3 out of 6, which I agree. If you compare it to everyone else, they're doing better than most people, but not IBM, which with AI coming along, I can see that this company is going to be hurting. Earning is 4 out of 6, and they're doing worse than their peers. They're doing worse than their peers, but they're still making pretty good money. Future growth. So if we're looking at the forecast, it looks like they're below industry standard, and that does make me concerned. And historical performance, they've been doing pretty well historically. 5 out of 6, and financial health is a 2 out of 6. I think they figure something happened, and the debt to equity ratio has been going up, and this is the thing I'm looking at. So based off that information of debt to, for the last 5 years going up, I just can't buy this stock because it looks like they're increasing their debts. And that makes sense why that the $50 million is somewhere. And you have to remember, I like to use AI because it does a quick analysis. Like I can look at the top stories and everything else like that. So what do I think about ADP? Yes, I think for my dividend portfolio, I will not add it. It does have a pretty decent growth, but the growth isn't there for me because I want a more of a 12 to 20% growth year over year. And this one does have a pretty good one at 23.66 last year, but the 3 years is at 28%. So if I do that math on that, it's not going to give me the growth I want. Yes, this will be a good stock to add to your portfolio if you want a good blue chip company. So don't ignore it because I say it's bad. It just doesn't meet my really strict requirement. Now, it does pay a dividend and it is a risk granted king or dividend king, which pays for 50 years. So it is a good stock to add to your company if you're looking just to add one and expecting about a 12% return every year plus your dividend, you'll get about 14% year over year on the average. And that's what I think about it. It's right there on the leverage. And the major thing I have issue with is right now with this company is not the growth. It's not the dividend. It's the finance. I am not going to go buy a company that's picking up more debt. And that's the reason why I'm not buying it. Now, does that mean it's a bad company? No, because it's right there on the borderline of me wanting to purchase it. But due to that increase of debt that it shows in AI and that $50 million that I can't figure out where it went for the cash flow for that year because they made a profit, that means there's some issues they're having with debt. And I just don't want to be owning a company that's currently trying to figure out how to handle their debt situation and increasing their debt. And that's just my personal opinion. I want a good financial standing, and this one doesn't have the strongest. It's okay, but it could teeter-totter either way on the debt. And I don't want to own a company that end up borrowing tons of money every year. It just doesn't make sense for me. Like and subscribe to my video, and that's all I got.